Yeah. So now let us move on to capital structure. What is capital structure basically? So capital structure, it refers to the mix of firm's capitalization. Now a firm won't raise its capital completely from equity or completely from debt or completely from preference shares. So it's not going to be 100% equity, 100% preference shares and 100% debt. It's always going to be a mixture, a combination of all the different long-term sources of finance. So that it refers to capital structure of a firm. Okay, now this mixture of the long-term sources of funds, like the percentage of debentures, the percentage of preference shares, the percentage of equity shares, the percentage of retained earnings, will depend upon the capital requirement of the firm. So the capital structure decision, it refers to deciding the forms of financing, that is the different sources which the company want to tap on, or the different sources from which the company wants to raise capital from. Basically, this will depend upon the requirements of the company, the amount which is needed by the company, that will determine the different sources from where they are going to raise the capital, and also the proportions in which they are going to raise the capital, whether it's going to be 50% equity, 50% debt, 40% equity, 30% preference shares. What is the combination basically they are going for? That will again depend upon the requirements as well as the forms of financing that the company is going for. Now, normally a finance manager tries to choose a pattern of capital structure which minimizes the cost of capital and maximizes the owner's return. Now, basically, that is the norm which is followed by everyone. Whenever you are trying to raise a capital, it should be in such a manner that the returns which you are going to generate by using that capital should be more than the cost which you are paying for raising that capital. Okay, so that is the normal norm. Now let us move on to understanding what is optimal capital structure. Now, there is a theory for optimal capital structure. Now, this theory of optimal capital structure, it deals with the issue of right mix of debt and equity in the long-term capital structure of the firm. Now, the finance manager should design the mix of debt and equity in such a manner that the returns are more and the cost is less. Okay, so that mix of debt and equity in a firm is the decision of a finance manager, which ultimately will result in optimal capital structure. Okay, so since the cost of debt is cheaper than raising the capital through issue of equity shares, the firm prefers to borrow rather than raising capital from equity. Now, as long as the returns on your investment are good, the cost of borrowing is less and the returns are more, everything is good. Everything is perfect. As long as your returns are higher than your cost, everything is good. But say, due to certain reasons, you could not get more returns. Say, a company could not make that much profits. They borrowed. A company took a loan from a bank, but the company could not make more profits. What will happen? Obviously, the company will go under liquidation at a certain point of time. The company will become bankrupt. So, why is that going to happen? Because basically, you are borrowing at a fixed cost. Right? So once you start borrowing at a fixed cost, it becomes your obligation to pay the interest as well as the principal amount after a certain period of time. Whereas when it comes to equity shareholders, you have no obligations towards equity shareholders, because equity shareholders are considered as the owners of the company. So even if tomorrow you are not making profits, the equity shareholders, they are not going to come outside and demand for dividend, because they know dividend they will receive only when the company is making profits. Otherwise, they won't receive any dividend. So that is the case with equity shareholders. But in this case, If you are borrowing more debt, okay, if you are preferring to go for debt source of finance over equity source of finance, everything is perfect as long as you are making more returns than the cost. Now, if you have to pay say 10,000 interest to the bank, but you are earning say 1 lakh out of the loan which you have taken from the bank, you are earning 1 lakh. So 10,000 paying 10,000 interest is not a big deal. But say tomorrow your profit is 1,000 rupees and the interest which you have to pay to the bank is 10,000 rupees. Is everything going to be normal? No. So that is the case. Even with respect to payment, I have told you all. First preference is given to interest payment. Second preference is given to preference dividend payment. And the last preference is given to the equity shareholders. If profit remains, then EPS or earnings are made available to the equity shareholders. Otherwise, no earnings are made available to the equity shareholders. Right? So that is the normal scenario, isn't it? If you are borrowing or if you are taking loan, you have to pay the interest and you have to pay the principal amount after a certain period of time. But when it comes to equity shareholders, that is not the case. Okay, equity shareholders are the owners of the company. Okay, that is not the case with respect to equity shareholders. So in this scenario, if say a company is relying more on debt over equity shares because they feel that debt is more cheaper source of finance than equity, everything is perfect as long as you are making profits, as long as the returns are more than that of the cost of borrowing. Say due to certain reason the cost of borrowing is higher than that of returns, what will happen? It is obvious to the equity shareholders that they are not going to get any benefits out of this, because the company, whatever profits are there, it's going to go directly to the debentures. Sorry, it's directly going to the debentures or the debt holders, isn't it? So they are going to make a fuss. So to a certain extent, in the beginning, as long as the returns on investment is more than the cost of borrowing, everything is good, and extra borrowings increases the EPS. The equity shareholders are also happy that the company is borrowing or taking loan from a certain bank and the profits are increasing, everything is going perfectly fine. The equity shareholders are happy as long as the profits are increasing and they are getting their earnings per share. They are happy. After a certain point of time, the risk and share price will fall. The risk will increase and the share price may fall. Why the risk increases? I will tell you all again. In the preference hierarchy, the first preference is given to the debenture holders or the loan. Okay, like the company is taking a loan from the bank, the first thing that the company should do is pay the interest. The first thing that the company should do is pay the interest in case of debt. So that is the first preference. After making payment of interest, then the tax payment is made. After making the payment of tax, then preference dividend is paid. And after preference dividend payment, whatever remains, that is made available to the equity shareholders. Now say the company is borrowing more and more money from the bank. The debt is increasing of the company. So basically what is happening, more and more profits will be given out to this debt, isn't it? Because the first preference for the payment is going to the debt, isn't it? Is going to the loan, is going to the bank, is basically going to debt holders, isn't it? So the first payment which the company makes is towards the debt holders. So if the debt holders are increasing, obviously a large chunk of the profit payment is going out to the debt holders. So obviously over a period of time the equity shareholders won't get that much returns. Okay, so as the debt increases, the risk for the equity shareholders increases because they are going to get less earnings per share as the debt increases. Okay, and this may result in the share price to fall. Okay, because the shareholders may consider that the more debt payments the company is making, the more debt the company is raising, basically a large chunk of the profit of the company is going for the payment of that debt interest. and very less amount or very less earnings are made available to the equity shareholders. So that is the reason why this scenario will happen. So initially everything is fine, but if you keep on increasing the debt, if the company keeps on increasing the debt, then everything will collapse. Okay, so that is the theory of optimal capital structure. It states that to a certain point of time, everything is perfect, everyone is happy, the debt holders are happy, the equity shareholders are happy. But after a certain period of time, the equity shareholders will show resistance because they will feel that they are having more risk as the debt holders are increasing, and as a result they will show resistance. Okay, so that is the scenario with respect to optimal capital structure. Now let us move on to EBIT and EPS analysis. Okay, let us try and understand what EBIT and EPS analysis is, but firstly let me go ahead with the optimal capital structure theory. Okay, now this is the formulae which is used basically in case of optimal capital structure theory. Now in this theory, what in this formulae basically what we are going to do is we are going to take two scenarios. In one scenario there is going to be all equity finance for a company, and in the second alternative there is going to be debt equity finance. So it's going to be a combination of debt and equity. Okay, and in the first alternative it's going to be all equity finance. And in this scenario we are going to find something called as indifference point. Now indifference point, it is nothing but a point at which two alternative finance sources, okay, now there is alternative 1 and alternative 2. At what point both of these sources will have the same EPS, that is nothing but indifference point. You can understand it better over here. There are two sources of finance. First it's equity, second is debt. At what point are they both going to have the same EPS? The earnings per share is called as indifference point. Okay, you can see initially equity is forward, they are happy, but then at a certain point what happens is it comes down and the debt is going high. So as the debt goes higher and higher, the equity shareholders are going to show resistance and they are not going to be that happy. Okay, why they are not going to be happy? Because they feel that the EPS will fall down. So you can see initially they are happy as the debt is increasing, but at a certain point the EPS will be the same in case of both the scenarios, and then equity it falls down. Okay, so this is this point at which the EPS is same in both the scenarios, that is all equity and debt mixture, that is nothing but the indifference point. Okay, and how are you going to compute it? You are going to compute it using this formula, that is EBIT minus interest in the first scenario multiplied by 1 minus tax divided by E1. E1 is nothing but the number of shares in alternative 1, whereas equal to EBIT minus I2, that is interest in case of the second scenario, multiplied by 1 minus tax divided by E2. E2 is nothing but the number of equity shares in alternative 2. Okay, so that is the scenario in case of indifference point. This indifference point will tell you basically at what point the EPS is going to be same for both the alternatives or for both the scenarios. Okay, so that is the case with respect to indifference point. That is the case with respect to determining the optimal capital structure for the company. Now moving on to EBIT and EPS analysis. Okay, let me start over here with EBIT and EPS analysis. Okay, the basic objective of financial management is to design an appropriate capital structure which can provide highest EPS, okay, over the firm's expected range of earnings before interest and taxes. So basically EBIT EPS analysis, the main objective is to design an appropriate capital structure which can provide highest EPS over the firm's EBIT. So basically any company wants to keep their share owners, basically the equity shareholders, happy, they will aim for providing the highest EPS for the equity shareholders. So the basic objective is that. Okay, so EBIT EPS analysis is a vital tool for designing the optimal capital structure of the firm. Now this formula in which we determine the appropriate EBIT EPS level. Okay, we use this formula in order to determine the indifference point, on the basis of which we determine what is the appropriate EBIT EPS level. So that will help us in order to develop an optimal capital structure. It also explains at what level of EBIT the EPS is going to be the same for both the financial plans, that is alternative 1 as well as the alternative 2. So basically it tells you the optimal capital structure. Now optimal capital structure, I told you, it is the one in which there is, in case of EBIT and EPS analysis, it is the one in which there is highest earnings per share which is made available to the equity shareholders. Okay, in case of EBIT and EPS analysis, basically we are trying to determine at what level the EPS is going to be the same for both the alternatives, and the alternative which has the highest EPS is considered to be the optimal one for the company. Okay, now basis of EBIT and EPS analysis, we will determine what is a good scenario for the company. So as I told you that this, that is optimal capital structure, indifference point, the formula will be basically used to determine which is a optimal plan for the organization. Now if the EBIT of that plan is greater than the IP, that is indifference point, then the plan with less equity shares is preferred, because the plan with less equity shares will have the highest EPS. Now EBIT is less than IP, say, or basically IP is more than EBIT. IP is nothing but indifference point. So indifference point is more than the EBIT. In that case, the plan with more equity shares is to be taken into consideration, because that plan will have the highest EPS. Now if say the EBIT is equal to IP, in that case the EPS is equal, and that point is nothing but IP, that is indifference point. Okay, so these are the scenarios which you will have to use in order to determine which plan to opt after you find the indifference point using this formula. So in using this formula, basically we'll have to find EBIT, which is going to be nothing but the indifference point. Now that indifference point we are going to use with the, we are going to compare it with the EBIT of that specific company. Now if the EBIT is more than the indifference point, these are the selection. If the EBIT is less than the indifference point, these are the selections. So basically that is how you will have to go about with it. Okay, so that is the thing. Now if the EBIT and the indifference point is the same, then you have got basically the indifference point, which is nothing but equal to EPS. So both the plans will have equal EPS. Okay, so both the plans are okay to go ahead with. Okay, so that is the scenario with respect to this. Now let us move on to the financial break-even point. Now let us understand what is financial break-even point. So financial break-even point is the minimum level of EBIT which is needed to satisfy all the fixed leverage charges. Now the fixed financial charges which are required to satisfy all the fixed financial charges. Now what are the fixed financial charges over here? There is interest, there is preference dividend. Now these two things are fixed charges. That is, irrespective whether the company is making profits or not, the company has to pay this preference dividend as well as the interest. So that is nothing but the fixed charges. Now it denotes the level of EBIT for which the firm's EPS equal to 0. Now financial break-even point, I told you, it is the minimum level of EBIT which the company needs to have in order to pay the fixed financial charges. So minimum EBIT which is required to pay the fixed financial charges. So obviously the first preference will go to the interest, the second preference will go to the preference shareholders. So financial break-even point is the minimum level of EBIT which you need to pay only these two things. So basically what you are saying that the EPS is zero, the earnings which will be available to the equity shareholders is going to be zero basically, isn't it? Because financial break-even point is the minimum level of EBIT which you need only to pay the fixed charges, that is interest and preference dividend, isn't it? So that is the minimum level of EBIT. So after paying the fixed charges, nothing is going to remain. So obviously the EPS is going to be zero in that case, right? So if the EBIT is less than the financial break-even point, then the EPS will be negative. Here only in the first scenario, whether it is minimum, EBIT is minimum, it is coming to zero. If the EBIT is less than the financial break-even point, obviously the EPS will be negative. Okay. But if the expected level of EBIT is more than the break-even point, then more financial instruments can be taken and otherwise equity would be preferred. Okay. So this is the thing. So financial break-even point, remember, financial break-even point, it is the minimum level of EBIT which you need in order to pay only the fixed charges. Fixed charges are nothing but interest and preference dividend. So after you pay interest and preference dividend, nothing is going to remain if the financial break-even point and the EBIT is the same. Now say if the EBIT is less than the financial break-even point, in that case you don't have enough funds to pay the interest and the dividend, preference dividend. What are you going to have to pay to the equity shareholders? So definitely the EPS will be negative in that case. I'll repeat again. In the first scenario, they are saying that the financial break-even point is the minimum level of EBIT needed to satisfy all fixed financial charges. So it is nothing but in the first scenario, the financial break-even point is equal to EBIT. So you can pay only the interest and preference dividend. But in the second scenario, they are saying if EBIT is less than the financial break-even point. In the first scenario itself, you were about to pay only interest and preference dividend and your EPS was coming zero. Now in the second scenario, they are saying that the EPS is less than that of the financial break-even point. So basically you are not having enough funds to pay even the preference shareholders and the debt holders. So what are you going to pay to your equity shareholders? So that is the reason why the EPS will become negative in case the EBIT is less than the financial break-even point. Okay. But if the EBIT is more than the financial break-even point, then you can have more debt instruments or you can have more fixed instruments like preference shares, debentures, you can take loan as you prefer, as well as you can take equity also, if your EBIT is more than that of financial break-even point. So financial break-even point is nothing but the minimum level of EBIT which an organization should have in order to pay the fixed charges like interest and preference dividend. Okay, so that is nothing but financial break-even point, whereas indifference point is the point at which two alternatives have the same EPS, that is two plans or the two structures have the same EPS, that is indifference point. Okay, so now let us solve some problems on the indifference point.
Okay, now let us start with a very simple problem. Okay, this is on EBIT EPS analysis. Okay, then we will move on to the different theories. But let us start with EBIT EPS analysis problems. Okay, so the problem states that there are two plans, plan 1 and plan 2. In plan 1, equity share capital is 10 lakhs and in plan 2, equity share capital is 5 lakhs. Then there is 10% debt, plan 1 5 lakhs, plan 2 10 lakhs. So the total funds in both the plans is 15 lakhs. They have given us the tax rate and they have asked us to find the indifference point. Okay, so now let us write down the formulae and solve. down the formulae. The formulae is EBIT minus interest of plan 1 minus tax divided by number of shares in plan 1 is equal to EBIT minus interest in plan 2 1 minus tax divided by number of shares in plan 2. Now, before we start, let me make this one thing very clear. When they are asking you to find the indifference point, basically they are asking you to find the EBIT. EBIT is the indifference point. I had mentioned this even in the PPT. Okay, so now let us solve. Now they have mentioned that the share price, that is equity share price per share is 10 rupees. So keep that in mind. So equity share capital, how much is it? In plan 1 and in plan 2. In plan 1, equity share capital is 10 lakhs and in plan 2 it is 5 lakhs. Then coming to debt. Debt in plan 1 and in plan 2. In plan 1, the debt is 5 lakhs and in plan 2, the debt is 10 lakhs. Okay, tax rate they have given us as 40%. The share price they have given us as 10 rupees per share. Okay, so all the details have been given to us. Now we just have to substitute it. So this is plan 1, this is plan 2. So let us solve. EBIT minus interest in plan 1. Now you know that this is 10% debt and in plan 1 the total capital under debt is 5 lakhs. So it's going to be, in order to find out the interest in plan 1, we are going to take the capital which is there, the debt capital in plan 1 which is 5 lakhs and multiply it with 10%. Why? Because it is 10% debt. Okay, so 5 lakh multiplied by 10%, you get 50,000. So interest in plan 1 is 50,000. 1 minus tax rate. Now tax rate they have mentioned over here, it is 40%. Okay, the whole divided by number of equity shares in plan 1. Okay, so now let us determine the number of equity shares in plan 1. Now we know the total capital, equity capital in plan 1, it is 10 lakhs, isn't it? We also know the share price per share, how much is it? 10 rupees. So how much is it coming to? It is coming to 1 lakh. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. It's coming to 1 lakh. So 1 lakh. Okay, is equal to, now let us solve the other side of the equation. EBIT minus interest in plan 2. Now you know the total share capital in plan 2 is 10 lakhs. Okay, into how much percentage debt is it? It is 10%. So 10 lakh into 10%. Okay, 10 lakh into 10%, it is coming to 1 lakh. So interest in plan 2 is 1 lakh. Then 1 minus tax. Tax is how much? 40%. So it is 0.40. The whole divided by number of equity shares in plan 2. So let us solve in plan 2. Okay. Plan 2, 5 lakhs is the total equity share capital divided by the share price per share is So is equal to EBIT minus 1 lakh multiplied by 0.60. So now let us open the brackets and multiply this inside. Okay, so we will get 0.60 EBIT minus 50,000 into 0.60, it will come to 30,000. Okay, the whole divided by 1 lakh. 0.60 EBIT minus 1 lakh into 60, that is 0.60, it is coming to 60,000. 50,000. Okay. The simple way to go about with this. Now both these equations are equated. So both these things can be subtracted. Sorry, it can be cancelled out. So 1, 2, 3, 1, 2, 3. 1, 1. 5 ones are 5, 5 twos are 10. So you will get now 1 and 2 over here. So you just have to cross multiply 1 and 2 rather than multiplying 50,000 and 1 lakh. Okay. So it is going to be 0.60 EBIT minus 30,000. 2 multiplied by 0.60 EBIT minus 60,000. Okay, so solving further, we will get the following equation. It is 0.60 EBIT minus 30,000 is equal to 2 multiplied by 0.60, it is coming to 1.2 EBIT minus 2 multiplied by 60,000, it is coming to 1,20,000. Now EBIT you get it in one side, and 30,000 and 1,20,000 you get it in one side. So it will come 1,20,000 minus 30,000. 1.2 EBIT minus 0.60 EBIT. Okay, so 1,20,000 minus 30,000, it will come to around 90,000 is equal to 0.60 EBIT. Okay, so you get this down, 90,000 divided by 0.60 is equal to EBIT. Okay, yeah. So you will get the total EBIT as 1,50,000. So an easy way to go about with this, you can, yes. So now let us start with the next problem. Ganesha Limited is setting up project with a capital outlay of 60 lakhs. It has two alternatives in financing the project cost. Alternative 1, 100% equity, and alternative 2, debt equity ratio of 2:1. Now the rate of interest payable on debt is 18%. The corporate tax is 40%. They have asked us to find the indifference point between the two alternatives. So basically what they have given us two alternatives. The first alternative is what? Okay, so in the ratio 2:1 is the debt equity ratio in the second alternative. In the first alternative, it is 100% equity finance. Okay, so 100% equity finance, and they want to raise a capital of around 60 lakhs. So basically, considering rupees 10 per share. Since they have not given us the share over here, let us consider the share price is rupees 10 per share. We can say that there are 6 lakh equity shares. That's the basic assumption. So assume equity price per share is equal to rupees 10. Assuming that capital, that how much we have to raise? Capital to be raised is equal to rupees 60 lakhs. Therefore, the number of equity shares is equal to total capital divided by share price, which is 10. So you are getting 6 lakhs equity shares. Okay, so you are getting total of 6 lakhs equity shares in the first alternative of rupees 10 each. Then moving on to the second alternative, where you have to raise debt and equity in the ratio of 2:1. So you have to raise debt and equity in the ratio 2:1. So let us find out that. Okay. So total capital to be raised ratio 2:1. This is debt equity ratio. Okay. So debt equity ratio is 2:1. So debt is going to be 60 lakhs into 2 divided by 2 plus 1 is how much? 3. How much is it coming to? And equity is going to be 60 lakhs into 1 divided by 2. How much is it going to be? I hope you all know how to solve ratios. The ratio which is given, it is debt equity ratio. So debt equity ratio is given. So debt is going to be 2 divided by 2 plus 1, 3. Equity is going to be 1 divided by 2 plus 1, 3. Okay, so what is the debt and equity ratio that you are getting over here? And equity you will get 20 lakhs. So we now know the ratio of debt and equity, how much we have to raise in case of second option. I hope that is clear. So now this information is enough for us to calculate the indifference point. Okay, so now let us calculate the indifference point, but before starting the calculation, let us determine how much interest we will have to take into consideration in case of second alternative. Because in case of first alternative, since 100% equity shares, we don't have to take into consideration the interest. But in the second alternative, since there is a debt capital of 40 lakhs, we have to take into consideration the interest. Now they have said that the interest is 18%. Rate of interest payable on debt is 18%. So we'll have to calculate 18% on 40 lakhs in order to get the interest. So interest is how much? Interest is equal to 40 lakhs into 18%. 40 lakhs into 18%, how much you are getting? You will get 7,20,000. Okay, so that is the scenario, that is the case over here. Okay, so now let us calculate the indifference point. Whenever such problems are given, make sure that you write down this information. Alternative 1, alternative 2, what are the details, and then accordingly go ahead and solve the indifference point problem. Okay, otherwise you all will get confused. Okay, let us write down the formula. EBIT minus interest in plan 1 minus tax divided by number of equity shares in plan 1 is equal to EBIT minus interest in plan 2 1 minus tax divided by solve this. Okay, so EBIT, this is plan 1 and this is plan 2. Okay, so EBIT minus interest will be 0 over here. Why it will be 0? Because in plan 1 the share capital is raised by 100% equity. So this is going to be 0. 1 minus tax rate was given as 40%, so 0.40. Divided by equity shares. The number of equity shares we calculated, it was 6 lakhs. EBIT minus interest in plan 2. We had calculated the interest in plan 2. It was 7,20,000. Okay, 1 minus tax, which is 0.40. The whole divided by number of equity shares. If you remember that the share capital was 20 lakhs. The share capital for equity in the alternative 2 or in the plan 2 was 20 lakhs. So 20 lakhs divided by 10, how much is it coming to? 20 lakhs divided by 10, it will come to around 2 lakhs. So the number of equity shares is going to be 2 lakhs in plan 2. Now we have to solve this equation. Okay, so 0.40 minus 1, it is going to be 0.60. The whole divided by 6 lakhs is equal to 0.60 EBIT. I am solving directly, okay? 1 minus 0.40, you will get 0.60. Now this 0.60 you have to multiply it inside. That is what I am doing. If you want, I will do it this way. 7,20,000 multiplied by 0.60. 1 minus 0.40, 0.60. The whole divided by 2 lakh. Okay. Now this we can cancel. 3 zeros, 3 zeros, 2 zeros, 2 zeros. 2 ones are 2, 2 threes are 6. Okay. So 1 is to 3. We got that. We can cross multiply the denominator. So it is going to be 0.60 EBIT, okay, is equal to, first let us open this equation. 0.60 EBIT minus 7,20,000 multiplied by 0.60. How much is it coming to? It will come to around 21 lakh, wait a second, 4,32,000. So it is coming to 4,32,000. This whole multiplied by the denominator, which is 3. Okay. So this 3 which we got after cancelling everything, this 3 we will have to cross multiply. This one we will have to cross multiply. 1 multiplied by the same thing is the same. So nothing changes over here, but here major changes are going to happen. So 0.60 EBIT is equal to 0.60 multiplied by 3. It's coming to 1.8 EBIT minus 12,96,000. 12,96,000. Okay, so this is the thing. Let us solve further. We'll have to get this side and this side. So it will become 12,96,000 is equal to 1.8 EBIT minus 0.60 EBIT. Okay, so 1.8 minus 0.60, you will get this as 1.2 EBIT is equal to 96,000. So 12 lakh 96,000 divided by 1.2 is equal to EBIT. So total you will get it as 12 lakh 96,000 divided by 1.2, we will get it as 10 lakh 80,000. So EBIT is equal to 10 lakh 80,000 is the in reference point. Okay, I hope this is clear. Okay, so now let us move on to the next problem. Yes. So now let us start with the third problem. Okay, so in this problem there is a company called Best of Luck Limited. It is a profit making company and has a paid up capital of 100 lakhs consisting of 10 lakhs ordinary share of rupees 10 each. Currently it is earning an annual pre-tax profit of 60 lakhs. The company's shares are listed and quoted in the range of rupees 50 to rupees 80. So this is the market value of the shares. They have given us the current paid up capital, which consists of equity shares of rupees 10 lakhs. Of rupees 100 lakhs, and the total number of equity shares is 10 lakh equity shares. Then the management wants to diversify the production and has approved a project with a cost of rupees 50 lakhs and which is expected to yield a pre-tax income of rupees 40 lakhs per annum. To raise the additional capital, the following options are considered by the management. So basically, there is a company called Best of Luck Limited. It has a paid up capital of 100 lakh equity shares. Okay, that is per share price is rupees 10. So there are around 10 lakh equity shares currently with the company. Okay, it wants to diversify further. Okay, and it needs a capital of 50 lakhs. It needs a capital of 50 lakhs, additional capital of 50 lakhs in order to diversify. For that purpose, the company has considered the following three alternatives. The first one is 100% equity, the second one is 100% debt, and the third one is debt and equity in equal proportions. Okay, so they have asked us to determine which is the best option for the company. Okay, so these are the details which are given to us. The first one is to issue equity capital for the entire additional amount. It is expected that the new shares of face value of rupees 10 will be sold at a premium of 15. Now they are stating that basically the issue of equity share capital for the additional amount, okay, the additional 50 lakhs which the company needs in order to diversify. For that amount only, they are stating that the equity shares are going to be issued at a premium of rupees 15. The face value of those equity shares is rupees 10 and they are going to issue those shares at a premium of rupees 15. So rupees 10 is the face value, they are being issued at a premium of 15 rupees. So the total amount is 15 plus 10, that is 25. Okay, so 25 is going to be the per share price of that equity, the additional equity which they are going to raise hereforth. Okay, that is the first case. The second case, they are stating that to issue 16% non-convertible debentures of rupees 100 each for the entire amount. So, in case they are going for debentures, which in the second case they are going for 100% debentures, in that case the interest rate is going to be 16%. Okay, so that is what they are saying, and the per debenture price is going to be rupees 100. Then the third case, that is the case in which the equity and the debt are going to be issued in equal proportions. With respect to that, to issue equity capital of 25 lakhs, face value rupees 10 and 16% non-convertible debentures for the balance amount. In this case, the company can issue the share at a premium of rupees 40 each. Now in the third scenario, what is happening is equity and debt are issued in equal proportions. How much is the amount that they are trying to raise? They are trying to raise 50 lakhs. They need 50 lakhs of additional capital. Okay, so 50 lakhs of additional capital, debt and equity are divided in equal proportions. So it is going to be 25 lakhs of debt and 25 lakhs of equity. Isn't it? It's going to be 25 lakhs of debt, 25 lakhs of equity. So the 25 lakhs of debt is going to be 16% non-convertible debentures, and in case of the remaining 25 lakhs equity shares, it's going to have a face value of rupees 10, but they are going to be issued at a premium of rupees 40. So rupees 40 premium, face value rupees 10, 40 plus 10, 50 is going to be the per share price of the equity shares in case of the third scenario. Okay, I hope the three scenarios are understood very well. Now let us try and solve this problem. Yes, so existing equity shares, in all the cases it's going to be 10 lakhs. Okay, so let us write in brackets over here, it is in lakhs. All the figures are going to be in lakhs. Okay, so existing equity shares, it is 10 lakhs. Now let us move on. Okay, so the next is now issue. Now currently how much they are going to issue in order to raise the new share capital, which is 50 lakhs. In the first scenario in which the entire amount, that is 100% equity, so the entire additional amount of 50 lakhs is going to be raised by equity. Okay, so in that case, what I had told you, in that case, the shares shall be issued at a premium of rupees 15. So face value rupees 10 plus premium 15, 10 plus 15, 25. Okay, so what is the total capital? The total capital, new equity shares. The total capital is 50 lakhs divided by 25 rupees. How much is it coming to? It will come to around 2 lakhs. So 2 lakhs of additional capital is going to be raised. So 2 lakhs of equity shares are going to be issued. I hope you all understood how we calculated this too. Okay, the total equity that is going to be raised in the first scenario is 100%. So the total capital which you need to raise is 50 lakhs. Right? 50 lakhs is the additional capital that the company wants to raise. Then, in the first scenario in the problem, it is mentioned that the shares are issued at a premium of rupees 15. So, since they are issued at a premium of rupees 15, the share price per share is how much? It is 10 plus 15, which is 25. So, 50 lakhs divided by 25, it will give you the number of equity shares, which is nothing but 2 in this case. Now moving on to the next equation. In the next equation we know that in the next problem, in the next alternative, we know that it is 100% debt. So no new equity shares are going to be issued over here. In the third option, equal number of equity shares, equal number of debt. Now, equal number of equity shares, equal number of debt. How much is the capital that is going to be raised? It is 50 lakhs. 50 lakhs is the total amount of capital that needs to be raised. Now since it is equally divided, it's going to be 25 lakhs of equity, 25 lakhs of debt. Okay, so the total equity capital is how much? 25 lakhs. Then in this scenario, in the problem, they have mentioned that the shares are going to be issued at 40 rupees premium. So 10 rupees is the face value plus 40, the total amount is 50. So 50 is the share price per share. So 25 lakhs divided by 50, how much is the number of equity shares? The number of equity shares is 50,000. So it is 0.50 because we are writing in terms of lakhs. I0. Okay, so this is the total equity shares which are there in each scenario. Now let us move on to debt. Debt. Over here there is no debt. Over here the total amount is the debt, which is 50 lakhs. Over here 25 lakhs is the debt, isn't it? So we know the debt. In the first scenario, since it is 100% equity, there is no debt. Over here it is 100% debt. So the total amount of 50 lakhs will be raised. Why? Debt. So it is 50. Over here in the third scenario, it is equal. That is, equity shares and debt, they are equally divided. So they are raising a capital of 50 lakhs. So 25 lakhs ka debt, 25 lakhs ka equity shares. So 25 lakhs is the debt. Okay. Now let us solve further. Estimated total income. Now this is clear to your respect to the capital that is going to be raised. Now estimated earnings. Okay. Estimated earnings. So total current operations. How much is the total? What is the earnings for the total operated operations currently? They are stated currently it is earning an annual pre-tax profit of rupees 60 lakhs. So current earnings are how much? Current earnings are 60 lakhs. 60 lakhs, 60 lakhs, 60 lakhs. Okay, and they are saying that from the new projects they are going to earn 40 lakhs. So if they go ahead with the new expansion or diversification project for which they require 50 lakhs of capital, they are going to have an income of 40 lakhs, an additional income of 40 lakhs. So new earnings are going to be 40 lakhs, 40 lakhs, 40 lakhs. Okay, so the total earnings are how much? 100, 100, 100. Okay, so that is the case. Now, from this we have to deduct the interest in order to understand what is going to be the EPS. Because I told you, the basis of selecting an alternative is on the basis of EPS. Whichever alternative is going to give us the highest EPS is going to be our option, our alternative which we are going to select. Okay. So that is the reason why in order to find out the EPS, basically we first need to deduct the interest, then we need to deduct the tax, then we need to deduct the preference dividend. Now in this case, since there are no preference shares over here, preference dividend does not come into consideration. But if there is preference share into consideration, in that case we have to take into consideration the preference dividend also. Now in this problem they have not mentioned anywhere preference shares, so we do not take preference dividend. But interest and tax we are going to follow. The same income statement pro forma which we had followed for leverages, we are following over here. Okay, so minus interest. Interest is how much? 16%. If you remember, it is 16% debentures. In the first case, there are not going to be any interest. Why? There is no interest in the first case. There is no interest in the first case because it is 100% equity. Okay. So let us move on to the next case, which is plan 2, in which we have 100% debt. That is 100% debt. So in case of 100% debt, we will have to calculate the interest. Okay, so now let us calculate the interest on 50 lakhs. So 50 lakhs into 16%, how much you are getting? You will get 8 lakhs. Okay, so interest we are supposed to deduct it, okay, from the total earnings. So make that a reminder by putting a bracket. Then the second option, we have 25 lakhs capital of debt. So 25 lakhs into 16%, how much is it coming? 4 lakhs. So 4 lakhs. Okay. So after that we will get profit before tax. So this is going to be 100. 100 minus 8, we are going to get over here 92. Okay, 100 minus 4, we are going to get over here 96. Okay, 96. Now, minus tax. Tax is how much? Tax rate they have given as 50%. So, 100 lakh, on top of this you have to take 50%. So, it's going to be 50 lakhs. Okay, so you are going to get profit after tax. Profit after tax is 50 in the first case. On this, we have to take 50%. So 92 lakhs into 50%, it is coming to 46. So after tax is going to be 46. So profit after tax is going to be 46 lakhs in case of the second case. In case of third case, 96 lakhs into 50%, it is coming to 48 lakhs. So 48 lakhs of tax you have to pay, and the profit after tax is 48. So we got profit after tax for all the cases. Now we can calculate the EPS, right? So profit after tax is 50 over here. So 50 divided by total number of equity shares, which is 12. So 50 divided by 12 is how much? It's coming 4.17. So EPS in the first case is 4.17, which you have got as 50 divided by 12. Okay. By doing 50 divided by 12. In the second case, earnings is how much? 46 divided by number of equity shares, which is 10. So 46 divided by 10, what is the EPS you are getting over here? You are getting it as 4.60. Okay. Then the third scenario, earnings after tax is how much? 48 divided by the total number of equity shares, which is 10.50. So 48 divided by 10.50, you will get 4.57. 4.57 is your EPS. Okay. So in all the three scenarios, you can see which scenario has the highest EPS. The 100% debt scenario has the highest EPS. So in that case, we are taking this second option because it is showing the highest earnings per share, which is available to the equity shareholders. Okay, so this option we are going to select. So now these were the three problems. I will be giving you some problems for your homework. I expect you all to solve those problems and upload those problems so that we can move ahead with the theories and wind up with capital structure. Okay, and then we can move to capital budgeting, and then the risk analysis part, and then we will be done with the second unit. Okay, I hope you all are studying for the fourth unit, because the fourth unit is completely theory based, and I have already given you all the fourth unit for presentations. So I expect you all to study that and be prepared. Okay, so that we are left only with working capital. Okay, we can finish that in a month. So my goal is to finish off everything before, or at least by 23rd of December. Okay, so please study. That's it for today.